China's once thriving startup scene is now in freefall. Once the darlings of the business world, many of these companies are disappearing at an alarming rate. Top executives are sounding the alarm, openly admitting that the industry's prospects have never looked this bleak. According to the Financial Times, the founders and investors behind China's tech companies have nearly given up hope of reliving their glory days. Giants like Alibaba and Tencent once dazzled the international stage, but that era seems to be fading fast. One Chinese executive expressed, "The entire industry is disappearing before our eyes. The entrepreneurial spirit is dead, and that's very sad." According to statistics from Chinese data provider IT Juzi, China established 51,302 startups during the peak of venture capital in 2018. But by 2023, this number had sharply declined to 1,202. Experts expect it to decline even more in 2024. The Financial Times reports that the industry's difficulties partly reflect China's economic slowdown. The economy has been hit by long pandemic lockdowns, a burst real estate bubble, and a stagnant stock market. U.S. investors are also pulling out as U.S.-China relations become more strained. 11 venture capital executives, including heads of state-owned and private funds, along with industry experts, scholars, and entrepreneurs, all paint a grim picture of the industry's future. An insider noted that 5 years ago, venture capital and private equity investors were the most optimistic people in China. Now they've become very pessimistic and are no longer visible. Reports say that venture capital firms are cutting investment professionals. Instead, they're hiring lawyers or former judges to handle repayment terms for failed investments. For example, law firms like De Heng and Zhonglun WD have shifted teams that used to handle IPOs and acquisitions to focus on advising redemption clauses. This situation ties closely to political decisions at the highest levels of the Chinese Communist Party, CCP. Policies cracking down on the tech industry have drastically changed the environment for private businesses. These measures target private companies on the grounds of monopoly or for not aligning with party values. The CCP also continues an anti-corruption campaign in the business sector. On December 30th of last year, the People's Bank of China approved a change to Alipay, designating it as having no actual controller. As a result, founder Jack Ma lost his control over the company, allowing the CCP to fully take over. Alipay's parent company Ant Group underwent an ownership change once. Jack Ma's voting rights were adjusted from 53.5% to 6.2%. This move signaled his exit as the actual controller of Ant Group. In November 2020, Beijing canceled the U.S. initial public offering, IPO, of Alibaba's Ant Group and summoned Jack Ma for a formal meeting. This marked the beginning of the decline in China's startup sector. This year, the CCP's procuratorial organs launched a special campaign called the Procuratorial Protection of Enterprises. They did this under the pretext of stabilizing social expectations and boosting market confidence. The campaign led to a sharp increase in prosecutions of private business executives. Chinese state media reports that 62,000 individuals were prosecuted for crimes disrupting the market economy order, marking a 36.5% increase from the previous year. They also prosecuted 5,827 key personnel in private enterprises for offenses like embezzlement, misappropriation of funds, and bribery. The number rose by 41.1% compared to the previous year. Political commentator Wang He believes this likely shows local governments seeking funds from private enterprises due to financial troubles. He stated, "Local governments practically have no funds at the moment, so who do they turn to for capital? The answer is only enterprises. Economic crimes by businesses are the best excuse. In the past, they used to raise, trap, and kill. Now it's just kill." The CCP is trying to get through this crisis, but it's making the situation worse for private companies. China's economy was already difficult. Now, with the added pressure from local governments, it's become an even bigger obstacle. The CCP's ongoing purge of the financial sector may crush the innovative spirit of Chinese startups. Recent reports show that in recent years, the CCP has launched a large-scale purge of the financial industry under the guise of anti-corruption. Incomplete statistics show that in 2022, about 77 officials in China's financial system were investigated. This number soared to 104 in 2023. As of September 10th this year, 67 financial professionals are under investigation. Bloomberg reports that since August, authorities have detained at least 3 top investment bankers from different securities firms. This has sent chills through the industry. Insiders revealed that Haitong Securities and other state-owned brokerages recently asked employees to surrender their passports. Some employees were told that regulators are reviewing IPOs and other financing activities. They could be summoned for questioning at any time. The ongoing purge has sparked panic in the industry. Chinese A-share listed companies face a wave of executive resignations. According to incomplete statistics, since August, within 27 working days, more than 1,100 resignation announcements have been issued by A-share listed companies. In recent years, the CCP leadership has pushed for so-called common prosperity. This has led to reduced salaries for financial professionals and, in some cases, the cancellation of bonuses. Professor of economics at Taiwan's National Central University said that the CCP's recent mention of national strategy taking precedence over excessive profit-seeking is almost unheard of in most countries. Industries achieve profits through market competition. Now, China is suppressing the growth of highly profitable industries. He said, in the US and Europe, as well as in Japan, the financial sector is usually highly profitable and well-paid. But in China, under the so-called common prosperity policy, highly profitable industries receive special attention. To some extent, financial professionals are treated as enemies. Earning more money seems like a crime. Under such an unusually strange system, many financial professionals feel like lying flat is a better choice. The CCP's control has steadily crushed the optimism of risk-taking entrepreneurs. A serial entrepreneur in Shanghai told the Financial Times, "There's no point in starting a business now. Why take the risk? We've already faced 5 years of startup failures." U.S. Ambassador to Japan, Rahm Emanuel, said on a media program that China's economy relies on entrepreneurship. It depends on global confidence in China's future and on investors willing to put money into the country. Emanuel remarked, "China has quite an entrepreneurial culture, and Xi Jinping crushed their entrepreneurship. And in crushing their entrepreneurship and the tactics he adopted, he crushed the confidence of the world in China." Estimates from 3 different venture capital executives show that state-owned funds now control about 80% of market capital in China. A Chinese innovation expert who asked to remain anonymous claims that the government is taking over startups under the guise of an anti-corruption campaign. He pointed out this goes against the core spirit of venture capital, which focuses on investing in high-risk, high-potential companies. Desmond Shum, author of Red Roulette and a former real estate tycoon, said the government has imposed strict control over the private sector. Shum further explained, even successful entrepreneurs may find themselves under tight surveillance. They can't move their funds overseas, and their transactions and public statements are monitored. This is because the CCP views their wealth as state assets. According to Chinese media reports, Zhongfu Li, the daughter of Wahaha Group's founder Zhong Qingzhou, resigned in mid-July, 145 days after taking over the company following her father's death. In a resignation letter circulating online, Zhongfu Li claimed that the Shangcheng district government and some Wahaha Group shareholders questioned the legitimacy of her management. This scrutiny came after Zhong Qinghou's death, making it impossible for her to continue fulfilling her duties. Because of this, she decided to resign as vice chairman and general manager of Wahaha Group. Former Chinese entrepreneur Hu Liren, who now lives in the U.S., believes Zhongfu Li has lost her authority over the company. This left control entirely to the local government. In his view, the CCP has already taken over the company. He stated, "The CCP uses various methods and excuses to target private enterprises. Their ultimate goal is to force business owners to give up their shares. The expropriation of private enterprise shares is now an open secret. The transition from private to state ownership is a major trend." Over the past decade, Chinese private enterprises have faced severe crackdowns. Many entrepreneurs and their families have been targeted, with their assets seized by authorities. A man known as a conscientious entrepreneur in China named Sen Dawu was sentenced to 18 years in prison in 2021 for his rights protection activities. Nearly 30 of his family members and senior executives were detained. The Dawu Group, which Sun led, was among China's top 500 private companies. Its assets were valued at over 5 billion yuan. However, officials valued these assets at only 686 million yuan and auctioned them off to a company established just 3 days earlier. The funding pool for Chinese venture capital firms is shrinking. Investors now see engagement with China as too risky and are distancing themselves from investments in the country. This includes foreign investors, wealthy Chinese individuals, and corporate investors, all of whom are withdrawing or reducing their investments in China. An investor told the Financial Times, in the past, U.S. limited partners focused on Asia were only interested in Chinese funds. Other markets like India barely caught their attention, but now we're like lepers. They don't want to come near us. Many funds are scaling back their investments in China. According to sources cited by the Financial Times, ByteDance's investor source code capital cut 50 out of 150 employees last year. Prominent funds like Sequoia Capital and Hill House Capital have also reduced the number of their offices in China. Even sectors that Beijing considers crucial for national security are struggling to attract investment. IT Juzi reported that in 2023, funding for biotech and pharmaceutical startups fell by 60% from its peak of 133 billion yuan in 2021. Public documents and informed sources indicate that firms like Sequoia Capital, Hill House Investment, Gen Fund, Shunwei Capital, and others are now looking overseas. They have either increased investments in foreign markets or are actively seeking deals in the US and Europe. A Shanghai executive noted, "People are voting with their feet," and he questioned whether Chinese venture capital can ever regain its former prosperity. He added that since his team and investment were all based in China, he has no choice but to stay. It's like being on the Titanic, waving goodbye helplessly as the ship starts to sink. China's State Administration of Foreign Exchange reported on August 9th that foreign direct investment liabilities in the second quarter of this year decreased by nearly 15 billion US dollars. This is only the second time on record that this figure has turned negative, with an outflow higher than the $12 billion in the third quarter of last year. This number shows the significant withdrawal of foreign investors from China. Bloomberg reported that if foreign direct investment liabilities continue to decrease for the rest of the year, it could mark the first annual net outflow since records began in 1990. The second quarter data reflect investors' growing pessimism about the world's second-largest economy. The report stated that after hitting a record of 344 billion US dollars in 2021, foreign investment in China has declined in recent years. The ongoing slowdown of China's economy and geopolitical tensions have sped up the withdrawal of foreign capital. According to a report by Nikkei, in the second quarter of this year, capital flowing out of China, specifically for factory construction, as well as mergers and acquisitions, exceeded the inflow. This is only the second time this has happened since 1998, with the capital outflow surpassing the $12 billion recorded between July and September 2023. Earlier data from the Ministry of Commerce showed that in the first half of this year, foreign direct investment in China hit its lowest point since the COVID-19 pandemic began in 2020. Meanwhile, China's outbound investment reached a record high. In the second quarter of this year, Chinese companies invested 71 billion US dollars overseas, an increase of over 80% compared to the same period last year. In recent years, Chinese companies have been ramping up their overseas investments. They're putting funds into emerging projects like electric vehicles and battery plants. China's State Administration of Foreign Exchange also reported that an unusual indicator measuring China's trade surplus continues to grow. It reached a record 87 billion US dollars in the second quarter. Additionally, a recent UBS report shows that the level of Chinese stock holdings by the world's top 40 investors, including both active and passive holders, has hit a 10-year low. According to the 2023 survey by the U.S.-China Business Council, more than one-third of American companies have reduced or paused their investment plans in China over the past year. Their top concerns include geopolitical issues and domestic policies. American law firms have also rapidly scaled back their offices in China this year. Data from Leopard Solutions shows that the number of employees in U.S. law firms operating in China dropped from 643 in 2022 to 545 by July of this year. former Minister of Finance of Taiwan, Yan Qingchang, said that various factors in the Chinese economy have led foreign investors to lose confidence in the Chinese market. Because of this, foreign companies are moving out of China to optimize their global strategies. The recently amended espionage law has broadened the definition of espionage. This situation makes foreign investors feel that coming to China could threaten the personal safety and free speech of their senior executives. Taiwanese financial expert Huang Shicong said that companies from Canada and the U.S. are now advising their citizens not to travel to China unless necessary. If people aren't going to China, then neither would funds. This issue has structural problems that are hard to overcome. Without foreign investment, China's exports will decline. When exports decline, the economy suffers. And when the economy suffers, foreign investors pull out even more. It's a vicious cycle. Huang believes that the decline in foreign investment, the sluggish housing market, and local government debt issues have created a downward spiral. Right now, the Chinese authorities have no clear solution to break this cycle.